Okay, welcome to Learned Be Accounting. And today our topic is accounting basics. So today we're going to basically be learning the foundation or the first things you should know once you want to begin your accounting journey. Or if you've already begun your accounting journey and you still find some some core things in accounting very confusing, this video is for you. So what is accounting exactly? In simple terms, okay, basically you have a business and you're running this business, you're buying, you create let's say you create drinks, or you create like lemonade for example, and then you run this business and you sell, and then you buy, you purchase materials for creating this lemonade, and then when you sell you make income. But in order for you to keep account on that whole process of you keeping account of this income, and then the money you used to buy these materials, your expenses, and then account, and then like that whole process, and thereby calculating if you made a profit from the business in order to continue. That whole process is basically accounting. Like what is stated on our screen, it's like it's a financial diary of a business and keeps track of all the money matters. And then in the modernized accounting, we don't just do that. We now arrange it or communicate it in a standardized way, so that in businesses now it helps the owners or external users make decisions. So now I'm going to talk about there are a lot of terms in accounting, right? But I'm going to talk about like five main ones, because that's what we're going to use in this our video. So we have assets, and there's a like an actual standard definition of what an asset is according to IFRS. IFRS, which being the regulatory body for accounting principles. But just for an easy understanding of just this basic term, asset is basically an economic resource owned. So any resource or any property or a resource that is owned by a particular person or a business that is used to generate future economic benefit, that's what an asset is. And then a liability is an obligation to pay. So a liability is like you are owing, you're obligated, you're obliged, or you have a responsibility to make payment to a particular person or for a particular thing. That is a liability. And then an equity is the owner's fund. So after you have paid all your liability from your assets, that net assets that is remaining is what you call your equity. That's the funds the owners contributed in carrying out that business. It can also be called capital. And then we have what we call the revenue or income, basically money coming in, the income, the money that comes in from the as a result of the business, the operations of the business that you're carrying out. And then we have expenses is the money going out as a result of the business that you're carrying out. So now this is an accounting equation is like the foundation, is the root of every of it's basically the root of accounting. It's like the main basis, the main foundation of accounting. And this accounting equation is this accounting equation is based, and this accounting equation is the basis of double entry principle. Now everything in accounting boils down to that accounting equation, which is assets is equals to liabilities plus capital. But for that equation to stand, for that equation to be accurate, to be correct, this double entry principle, I'm sure we have all learned something, we have all heard of double entry principle through our accounting journey, or even if we're just beginning our accounting journey, we've heard something like double entry principle. So for that accounting equation to stand, this double entry principle must be followed, must be run. What is the double entry principle? The double entry principle is saying that every transaction must have two entries. That for every transaction it has two sides. There's not just one transaction, there's not just one way to every transaction. That for every debit entry there's a corresponding credit entry. So whatever transaction it is, there is no exception for this rule. Whatever transaction it is, whether it be a liability, an asset, a capital, or income, expense, it must have an offsetting effect. So there must be a corresponding effect for that accounting equation to stand. Now every transaction must be recorded in two places. That's basically what this double entry principle is saying. And then in accounting, do you see like T accounts, and we've heard of debits and credits. And now there's this misconception that people have that okay, debits means right, like all the good things should be debited and then all the bad things should be credited. That is wrong. Wrong. So the basically debit doesn't necessarily mean right, and credit doesn't mean wrong. Instead, take debits as okay, the left side of the account, and take credit as the right side of the account. Because in accounting, there are rules of what should be debited and then what should be credited. There is nothing like okay, debited, only everything that is right should be debited and everything that should. There's nothing like that. There are things. There's a rule, and it's basically part of the double entry rule, and the rule is debit assets, expenses, and drawings, credit liabilities, income, and equity. Now, I call it my I myself I call it the dead CLIE rule, but you can come up with any form of acronym you can want to call it. I call it the dead, but I spell the dead this way, but you can spell it um the actual way you spell dead, or you can change whatever, you can change it to whatever acronym you want. So basically, this is the rule in accounting. Like any accounting, once you're given a trial balance, whatever, anything from the basis of accounting, whatever you are doing in accounting, this rule must be known. You must know that you debit assets and expenses, and then and your drawings, and then credit liabilities, income, and equity. Now I've explained what assets is, I've explained what expenses is, but I haven't touched what drawings are. So you know, our equities are the owner's fund, basically the money the owner brings into the business to control it. So drawings are the amount, the goods, or the money that the owner withdraws from the business for their personal use. Now, there's something I have not mentioned. I have not mentioned the business entity concept. Now, there are several concepts in accounting, but this concept is very core. I want you to take note of this business entity concept. This basically say that the business is a legal person on its own. So it's the legal person, and it is different from the owner. So that's why there are things like the equity and the drawings, because this drawing now, if the business is different from the owner, so the business takes record of when the owner is removing amounts of money for their personal use. So this are what is debited, and then this are what is credited. These are what is debited, and this are what is credited. So when this, because of these are debited, they are called debit balance. So they can ask you, does assets have a debit balance? The answer is yes, because once it is increasing, it is debited. Once expenses are increasing, once you are making expenses, it is debited. Once drawings are increasing, once you are making drawings, it is debited. And then credits, liabilities, income, and equity, they have what you call a credit balance, because once they are increasing, they are credited. Now the opposite is for when they reduce. So an asset now, because you know that it's a debit balance, if you have to purchase, if you have to purchase an asset, or if you have to buy more assets, or your assets should increase by any way, you have to debit your assets account. But in a situation whereby you sell off an asset, or your asset reduces in any way, it is then credited. So as an asset reduces, it is then credited. So if your asset is to reduce in any way, you credit it, because in debiting is increasing it. So to reduce that debited amount, you credit it. So that's the same way it is for a liability, because it's a credit balance, and therefore increasing it is therefore credited. To decrease it is therefore you have to debit it. That's why it's going this way, because of when you are reducing a liability. Let's say you are a liability is, like I said, an obligation to pay, and therefore you are obligated to pay someone 1,000 naira, and then you pay the person 100 naira today. Therefore you have reduced that liability. So therefore you are going to debit 100 naira in the liability account, and therefore reducing the balance of the liability. Do we get that? Okay. So this is basically the same thing. Assets, expenses, and drawings are debited. Liabilities, income, and equity are credited, because these are debit balances, and these are credit balances, and as they increase, this is the side of the account that they maintain. But if they decrease, it is the opposite side. Okay, so we're going to look at some illustrations so that we'll be able to like detail or discern the two entries of each transaction. But before we get there are core things I want us to always remember or recall. Asset is equals to equity plus liability, and every transaction must have a debit and a credit entry. This is basically the double entry principle, that whatever transaction you are giving, there are always two ways to it. There's a debit and then there's a credit entry. So we should not just record one account for it. Then debit always equal credit. So if every transaction has a debit and a credit entry, the amount that you're going to debit in a particular entry is the same amount you're going to credit in another entry. So therefore debit always equals credit. Then debit and credit isn't right and wrong, it just is. So debit and credit isn't right, it doesn't mean right and it doesn't mean wrong, it just is. So we should not have this misconception that debit means the good stuff and then credit means the bad stuff. No, we shouldn't have that. Instead, there's a rule that we should follow of what to debit and then what to credit. So my rule or my acronym is what I call the DAED CLIE rule. DAED CLIE. Debit your assets, expenses and drawing. Credit your liabilities, income and equity. So that's all for this video. In the next video we're going to be there's going to be a list of transactions, and we're basically going to be posting them and learning how to post them into their different accounts using the double entry principle. Thank you.